Have you ever wondered where the rules for global banking actually come from? Well, a lot of them were born in a single chaotic summer. A summer so full of scandal and collapse that it forced the world's most powerful bankers to basically write a new rulebook from scratch. That was the summer of 1974. And the aftershocks from that crisis created the very foundation of the financial system we all live in today. So, let's dive in. So here's the billion-dollar question that regulators were facing in the early 1970s. With new technology, money was moving at lightning speed. Think about it. A bank in Europe could get a payment during its business day, but before it could send the US dollars out from its branch in New York, it could literally go bankrupt and cease to exist. And look, this wasn't some philosophical puzzle. This was a very real, very expensive problem that was about to blow up. All right, to really get what happened, you got to picture the 1970s. The old staple financial order that had been in place for decades, it was gone. And what replaced it was this high-stakes, high-speed, and dangerously unregulated, well, it was a financial Wild West for international banks. This timeline really shows you just how fast the dominoes fell. You see, for about 25 years after World War II, the Bretton Woods system kept currency values stable and pretty predictable. But then, boom, 1971, that all goes out the window. Suddenly, currencies are floating, their values are changing every single day. This created enormous new risks for banks, which were being run by traders who had never seen anything like it. And then the OPEC oil crisis hit, which was like pouring gasoline on an already raging fire. And here's where it gets really wild. All this new risk was happening at the same time as this insane, unchecked growth. You had the rise of the eurodollar market, which is basically a giant unregulated pool of US dollars held in banks outside the US. This meant huge amounts of money were flying around beyond the control of any American regulators. Capital could suddenly flow freely across borders, and US banks were expanding overseas at a pace that was just breathtaking. So the key takeaway here is this. The global banking system was getting bigger, faster, and way riskier, far beyond the reach of any single country's rulebook. Okay, so we've set the stage. Now let's fast forward to that summer of '74, when all of this came crashing down. The cracks in this new system didn't just appear. They ruptured, triggering a series of bank failures that sent absolute panic across the globe. Picture this. A German bank called Bankhaus Herstatt had spent its day in Europe taking in payments in Deutschmarks from other banks, but before it could pay out the corresponding US dollars from its accounts in New York, German regulators shut it down at the end of their business day. Well, for the banks in New York waiting for their money, it was only 10:30 in the morning. The money they were owed, it had just vanished into a regulatory black hole between time zones. And just like that, this spectacular failure gave a name to a danger that had been lurking in the system all along. Herstatt Risk. It's the ultimate nightmare in foreign exchange. You've held up your end of the deal, but the other side just disappears before they can hold up theirs. It was a perfect and devastating example of how the speed of finance had completely outrun the rules of global regulation. And the scale here, it was just staggering. We're talking about liabilities of $840 million. I mean, the panic was so intense that the main international payment system in New York, CHIPS, was actually suspended for a while. Trust, the absolute bedrock of banking, it just evaporated overnight. Banks stopped lending to each other, and the entire system just started to seize up. But Herstatt was just the beginning. It wasn't just Herstatt. You see, that same summer, a rogue trader at a Swiss branch of Lloyds Bank racked up huge hidden losses, exposing a shocking lack of internal controls. And then the Israeli-British Bank failed, which raised this terrifying new question. If a bank's subsidiary in London goes bust, who's responsible? The regulator in London or the one back in Israel? Each failure pulled back the curtain on a different fatal flaw in the system. Okay, so the entire system is on the brink of a full-blown meltdown. The governors of the G10 central banks, we're talking the world's most powerful financial officials, they knew they had to do something. They could not let this happen again. So they got together to create something new. And that something was a new committee based in Basel, Switzerland, which we now know as the Basel Committee on Banking Supervision. Its mission was simple but incredibly urgent. Figure out a way to stop international banks from collapsing and taking the whole system down with them. So their first crack at a solution was what they called an early warning system. Makes sense, right? The idea was if regulators could just share market intel, maybe even rumors about banks that were in trouble, they could stop a crisis before it even starts. But there was one huge problem: getting these fiercely independent countries to share sensitive information. I mean, listen to this quote from the French representative. He basically said, "There's no way I'm sharing rumors about my banks with other countries." National regulators saw their relationship with their home banks as totally confidential. They were happy to get gossip from other countries, but they fought against any rule that would force them to share secrets about their own banks. They saw it as an attack on their national sovereignty. So, yeah, that first big idea, it was a total flop. The committee realized they couldn't just build a system on gossip. The problem was much, much deeper, more structural. They had to answer the bigger questions that the other bank failures had brought up. And it all boiled down to one simple fundamental question: who's in charge here? When a bank operates all over the world, with branches and subsidiaries in dozens of different countries, which single regulator is ultimately responsible for making sure the whole thing is safe and sound? So you had these two competing ideas, right? On one hand, you have the parent authority. That's the idea that the regulator in the bank's home country is responsible for everything, everywhere. On the other hand, you have the host authority idea, where the regulator in each country is responsible just for the operations inside its own borders. Before 1974, nobody had a clear answer, and that created these massive, dangerous gaps where a bank could just fall through the cracks, supervised by no one. So, what was the solution? It was this landmark agreement, the 1975 Basel Concordat. This was the first ever international rulebook for banking supervision, and it laid down this absolutely revolutionary rule: no foreign banking establishment should escape supervision, period. It made supervision a shared job, with the parent authority watching the bank globally and the host authority watching its local operations. It was a blueprint to finally close those gaps. So when you step back and look at it, what's the real legacy of this one crazy summer? It's huge. The entire framework for global financial regulation that exists today, the Basel Accords on capital, the rules for cross-border supervision, all of it was literally born from this one crisis. You can draw a straight line. Step 1, the crisis happens, and it shows everyone the massive gaps in the system. Step 2, the big players form the Basel Committee to fix it. Step 3, they create the Concordat, which establishes the core principles. And that, step 4, becomes the bedrock for everything that has followed for the last 50 years. But here's the thing. That core problem they identified way back in 1974, it never really went away. Finance is truly global. It's instantaneous. But regulation is still mostly national. And that challenge of supervising a global system with this patchwork of different country regulators is still the central problem in finance today. Which brings us to our final question, and it's a big one. The rules we have today were forged in the fires of 1974, but the financial world has become infinitely faster and more complex since then. In this constant, never-ending race between innovation and regulation, can the supervisors ever really keep up?